What is KYC and why does it matter? KYC, otherwise known as Know Your Customer or Know Your Client, is a set of procedures for verifying a customer's identity before or while doing business with banks and other financial institutions. Compliance with KYC regulations can help keep money laundering, terrorism financing, and more run-of-the-mill fraud schemes at bay. By first verifying a customer's identity and intentions at the time of account opening and then understanding their transaction patterns, financial institutions are able to more accurately pinpoint suspicious activities. What is KYC in banking? KYC means Know Your Customer and is a standard due diligence process used by financial institutions and other financial services companies to assess and monitor customer risk and verify a customer's identity. KYC ensures that a customer is who they say they are. Under KYC, clients must provide credentials that prove their identity and address. Verification credentials can include ID card verification, face verification, biometric verification, and /or document verification. For proof of address, utility bills are an example of acceptable documentation. Why is KYC important? By law, KYC is required for financial institutions to establish the legitimacy of a customer's identity and identify risk factors. KYC procedures help prevent identity theft, money laundering, financial fraud, terrorism financing, and other financial crimes. Non-compliance can incur heavy penalties. KYC requirements were introduced in the 1990s to fight money laundering. Following the 9/11 attacks, the U.S. passed stricter laws around KYC as part of the Patriot Act. These changes had been in the works prior to 9/11, but the terrorist attacks provided the political momentum needed to enact them. Identity theft. KYC helps financial institutions establish proof of a customer's legal identity. This can prevent fake accounts and identity thefts from forged documents or stolen identity documents. Money laundering. Both organized and unorganized criminal sectors use dummy accounts in banks to store funding for narcotics, human trafficking, smuggling, racketeering, and more. By spreading the money out across a long list of accounts, these criminal sectors seek to avoid suspicion. Financial fraud. KYC is designed to prevent fraudulent financial activities, such as using fake or stolen IDs to apply for a loan and then receive funding with fraudulent accounts. What's the difference between AML and KYC? The difference between AML, anti-money laundering, and KYC, Know Your Customer, is that AML refers to the framework of legislation and regulation that financial institutions must follow to prevent money laundering. KYC is more specific and relates to verifying a customer's identity, which is a key part of the overall AML framework. Financial institutions are responsible for developing their own KYC programs. However, AML legislation can vary by each jurisdiction or country, which means that financial institutions must develop KYC procedures that comply with each set of AML standards. Who needs KYC? KYC is required for financial institutions that deal with customers during the opening and maintaining of accounts. When a business onboards a new client, or when a current client acquires a regulated product, standard KYC procedures generally apply. Financial institutions that need to comply with KYC protocols include banks, credit unions, wealth management firms and broker-dealers, finance tech applications, fintech apps, depending on the activities in which they engage, private lenders and lending platforms. KYC regulations have become an increasingly critical issue for almost any institution that interacts with money, so, just about every business. While banks are required to comply with KYC to limit fraud, they also pass down that requirement to those organizations with whom they do business.